Hi everybody, this is session 1.5, and in this session we're going to be talking about boards and officers as the controlling individuals of a nonprofit. The board oversees the nonprofit activity, the officers carry out that vision. You remember we talked about this idea in session 1.4 when we laid out the common structure of nonprofit corporations with boards hiring officers and then officers hiring employees. And so we're going to talk today about boards and officers, and then in the next unit, in the next class session 1.6, we'll talk about employees and volunteers. So let's get a reminder of the learning goals for this session. I want you to know the legal and other important qualifications of a nonprofit director. Describe how officers are chosen, compensated, and removed. I want you to be able to explain the duty of loyalty, the duty of care, and something called the business judgment rule. And then finally, know the 7 indicators of good governance in a nonprofit organization. Let's start by talking about directors broadly. The board of directors is the group ultimately responsible for the success of a nonprofit. Sometimes boards do a pretty good job of scapegoating, for example, a bad executive director or a bad CEO, and they don't take responsibility for the fact that they hired that person. Part of it is because responsibility becomes diffused across a board. Part of it is because the board's not involved in the day-to-day management, and so they blame the day-to-day decision-making for anything that might go wrong. But really, the board is the one who, the board members are the people who should be overseeing this nonprofit to make sure it's well run and paying attention to those potential mistakes that might cause its harm or downfall. And so recognizing that boards have this very high responsibility to keep the organization healthy and successful. Let's talk about what it takes to be a board member for a nonprofit. These are the legal qualifications to be a member of a board of directors for a nonprofit. At a minimum, you have to be 18 years old, and that's it. And that really is it, unless there's a special ruling that says otherwise. So there are some people who could be banned from serving on nonprofit boards because some special ruling banned them from being on a board due to some past bad behavior. But unless that's the case, you qualify. And so there's no special legal qualification for being on a board other than being a legal adult. That would mean, for example, that in recruiting for your board of directors, you could recruit Elizabeth Holmes. You may remember she was the founder and CEO of Theranos, which is a blood testing company. She was charged and found guilty of multiple counts of fraud, lying about the machines to her investors. She did lie to them, her patients as well, although she wasn't found guilty for that. But she's in prison right now, serving an 11-year prison sentence. And although she's, as this headline says, she's appealing her conviction, she's still in prison. But that wouldn't stop you from recruiting her to be on your board of directors, because that's not a legal limitation. Now, just because the law allows you to recruit a wide variety of people to be on your board doesn't mean that just anybody should be on your board of directors. When we're talking about what it takes to be an effective board member, these are the sorts of qualifications we'd look for. For example, we would want you to be a donor. Pretty much 100% of your board should be donors if you rely on donations from others. The obvious reason of that is because you want to be able to tell the public that your board all consists of donors. A board member might be on your board because they have some sort of special abilities or knowledge. You might want a lawyer or an accountant for their expertise. You might want a parent if you're serving youth. You might want a member of the community that you're serving. Like if you serve ex-convicts, you should probably have an ex-convict on your board. Your board members should be available, meaning they will answer your calls when you call them. They'll attend board meetings. We'll talk about a legal reason it's important for them to attend board meetings. You want board members who are connected and well networked in the community, because a board member might be just one leap away from somebody in power or somebody with influence that's important for you to persuade. And obviously your board should be committed to the mission of the nonprofit. It's important to note that unless it's a membership nonprofit, board members elect themselves. So the existing board members will appoint new board members. And so you got to have a good board to begin with. And that's important when you get started. It's interesting to look at the demographics of nonprofit boards in the United States. You can see there's a strongly biased orientation toward white Americans versus those of other racial or ethnic backgrounds. Um, and and so that's something that needs more diversity, I think. It's interesting, though, to look at diversity of gender, age, and racial background by the age of organizations and by the size of organizations. As you might predict, older nonprofits tend to have less diversity in their board members, and larger nonprofits tend to have less diversity in their board members. That's an interesting trend that's worth noting. We can talk about that more in class. The research does show, however, that there are practical, pragmatic reasons to have diverse boards of directors, not diversity for its own sake, but because the research shows that boards with higher diversity in gender, age, and race tend to be more engaged in fundraising than less diverse boards, and more engaged in advocacy on behalf of the nonprofit. You just simply get more engagement out of your board with a more diverse board. And so that's pretty much all we're going to talk about here in the recording. We'll discuss some other things about board members when we get to class. Let's talk about officers. You remember from the org chart we saw in the previous class session about nonprofit corporations, officers are the ones hired by the board to carry out the board's mission or vision. A few things to remember about officers is they're employees, but they're really kind of super employees is what I like to call them, because they have added responsibilities beyond just being a regular employee. And we'll talk about that when we get to their legal duties. All officers are a product of the bylaws. You're an officer if the bylaws say that you are. And you remember that the bylaws are the internal controlling documents, the sort of rules that the nonprofit adopts. And the rules, that organizing document, the internal rules, define who is and who is not an officer. Like we mentioned, the board is in charge of hiring the officers, firing them, and determining compensation for them. Sometimes you have an officer who's also serving as a board member, and decisions about their job prospects or their compensation, they should not be part of the vote about how much they're paid or if they're going to be kept on. And like we said, officers are charged with implementing the board's decisions and direction. So that's all I have on officers, and that's how they work. So they're just basically like super employees. Let's talk about these legal duties that apply to both board members and to officers. These are fiduciary duties. You may remember in session 1.4, we talked about how there are legal duties that apply to there are legal duties that apply to people where they have to put somebody else's interests ahead of their own. And when that happens, it's what's called a fiduciary duty. These are two examples of fiduciary duties that apply to boards and officers. The first is the duty of loyalty, and then the second is the duty of care. The duty of loyalty, first of all, prohibits self-dealing, which means you can't use the nonprofit's resources to benefit yourself personally in a way that comes at the expense of the nonprofit. And that should be obvious, but it is part of the duty of loyalty. But it also requires disclosure of competitive endeavors. And so, for example, if I was working for the Boys and Girls Club and I wanted to start a new chapter of the Boys and Girls Club, or let's say I had a donor come to me who wanted to put $1 million toward helping kids in our community. If I took that donation opportunity and then I branched off and started a brand new nonprofit all by myself and paid myself as the founder and CEO or whatever, then we have a problem, because I should have disclosed that opportunity to the board of the Boys and Girls Club, where I was serving as a board member or officer. This is called the corporate opportunity doctrine. And the idea is that in this instance, you can see my interests are in conflict with the nonprofit's interests, and the nonprofit has to come first. So what I have to do in this situation, I have to say, hey, my friend or neighbor wants to donate $1 million toward serving kids in the community. Let them be aware of that so that they can sort of pitch the idea to my neighbor. Now, if my neighbor chooses not to donate to them and then decides to donate to me instead, that's fine, because at that point the opportunity was given to the nonprofit and didn't materialize. But I have an obligation to take that opportunity and present it first to the nonprofit that I have a duty of loyalty toward. Let's talk next about the duty of care. How good of a job do you have to do if you're a board member or officer? How much care do you have to show in the quality of your job? Well, courts would say, first of all, that you have to show reasonable care. Now, reasonable here, I have in quotes because it's going to be defined by a jury. If you were sued over violating the duty of care and it was a jury trial, then the jury would get to decide what is or is not reasonable. And of course, the attorneys would argue about what might or might not be reasonable under the circumstances. That leaves a lot of ambiguity in the law if we rely just on jury's interpretation of reasonable. So courts have given further definition to make more sense of what it means to show care in your job. At a minimum, it requires a director officer to be informed. And so you can't skip all the board meetings, have things be going terribly, and then when you get sued personally for violating the duty of care, your defense cannot be, well, I didn't even go to board meetings, so I didn't know what was happening. That's a violation of your duty of care. You have to be informed the way a typical director officer would be informed. Well, let's say you're informed and you just made bad decisions. Let's say you were doing your job and then you made some bad decisions that ended up harming the nonprofit. Well, we're going to judge the quality of those decisions, legally speaking, by something called the business judgment rule. And the business judgment rule basically says that courts cannot examine a board's decision or an officer's decision unless the only explanation they have for that decision is that it was so far beyond the bounds of reasonable judgment that it seems essentially inexplicable on any ground other than bad faith. Now, this is a very lawyerly way of saying courts can only examine decisions for violating the duty of care if those decisions are so bad that the only explanation we have is that they were intentionally bad. That's what a bad faith decision would be, is an intentionally bad decision. And so courts can only analyze bad faith decisions. And that gives you a ton of latitude as a board member or officer. Now I have Michael Eisner is pictured here with his friend Michael Ovitz, and I'm going to tell a story about a famous case involving the business judgment rule and Disney, where the shareholders sued Michael Eisner and the board of directors. Michael Eisner was the CEO of Disney at the time. I'm going to tell you a story about how they hired a bad president for Disney and it went terribly and they all got away with it. So we're going to talk about that in class. All right, so some questions we'll discuss together in class. Is it fair to impose these legal duties, the duty of loyalty and care, on like unpaid direct boards of directors? We mentioned in class that the vast majority of nonprofit board members are not compensated in any way. So is it really fair to impose these legal obligations on them? And related question is, are unpaid directors truly unpaid, or are they getting some other form of compensation, which we'll discuss? Why should the duty of loyalty supersede personal interests? Why is it that you have to give up your own well-being if it conflicts with the nonprofits? And an inverse question to these is, do these duties go far enough? Are we expecting a high enough standard of behavior from the people who run nonprofit organizations? So let's talk just a little bit about governance. Governance is the general idea of setting standards or rules of behavior so that the people running organizations are running their organizations effectively and honestly. And so it's interesting to ask this question as to who holds these various entities responsible. Well, corporations have shareholders, governments have voters, but nonprofits, unless they have members, only have boards. And so in a sense, nonprofits are holding themselves accountable, whereas government, elected officials have their voters and corporations have their shareholders. Nonprofits don't have similar stakeholders with the same kind of power. They are expected to hold themselves responsible, which you can imagine creates opportunities for them to behave badly. When we talk about governance, some important concepts to consider are first that insiders are the ones who cause most governance problems. So it's somebody inside the organization who's misbehaving. Systems are better at governance than simple trust. There's a strong instinct in the nonprofit sector to simply trust people, but trust doesn't provide adequate guardrails often. And I know lots of stories of nonprofits who got ripped off because they were too trusting. I'll maybe share a story or two in class. And the other thing to note about governance is that it's pretty expensive. Putting these systems in place, making sure they're followed, costs time and money. And so to have good governance, you have to invest in it. Let's see, I need to recommend slide notes on a couple of these standards or indicators of good governance. We'll get to them in a second. But here are the 7 I just want to review quickly, then we'll wrap up this recording. One indicator of good governance is public disclosure. When a nonprofit is sharing information actively with the public, when they put their 990s, their tax filings up on their website, or their audited financial statements or an annual report up on their website, that's an indicator of public disclosure. Anything that a donor maybe has a right to know, or that might be important to a donor's decision, is the kind of information that a nonprofit should disclose. A good nonprofit will have a diligent board of directors who meets regularly and does their job. They'll have and implement a conflicts of interest policy. Conflicts of interest policies we'll talk about in the finance part of the course, but generally speaking, it just means that when somebody has a loved one or themselves given the opportunity to benefit financially, they disclose that to the leaders of the organization so that that conflict can be managed properly. They use rigorous financial accounting. Small nonprofits tend to violate the standard of good governance because they get a little sloppy in their bookkeeping. They have appropriate program expenses. Now, here you're going to see in sort of out in the nonprofit world that generally speaking, the advice is you should spend $3 on your programs for every $1 on overhead. But it's important to emphasize that this does not measure actual impact. This just is a measurement that's a byproduct of the tax form, the Form 990 that nonprofits do every year. We're going to get into that idea in more detail, but just know that a general guideline in the nonprofit industry is that you should have a 3-to-1 ratio of $3 on your charitable programs for every $1 spent on overhead. And overhead's going to be like administrative stuff plus fundraising expenses. You should also engage in ethical fundraising. That means obviously being honest and transparent with donors, but it also means being efficient in your fundraising. You all may have gotten a fundraising phone call or two in the past, and odds are pretty good that those fundraising calls came from private firms, like for-profit fundraising firms, that allied themselves with a nonprofit. And it's often the case that those for-profit fundraisers are capturing 90% of the donation. Ethical fundraising, at a minimum, should double your money, meaning that if you spend $1 on fundraising, you should get $2 back in donations. Anything less than that means you're doing a pretty bad job. And so ethical fundraising would have this minimum of a 2-to-1 ratio, $2 back for every dollar spent. And then finally, you should respect donor privacy. Donors often give privately for important reasons, and you want to make sure you don't inadvertently disclose donor information. So those are the 7 standards or indicators of good governance that we will talk about more in class, and I'll see you then.